So same thing, Mr. A and Mr. B bought the property. In this case, too bad. Prices, instead of going up, actually moved downwards. If in this case, the market value is only $800,000. If Mr. A sells the property now, he will make a loss of $200,000. Correct? On the other hand, Mr. B, because he took a loan, right? So there's an additional interest of $50,000. So his loss is even bigger, right? $250,000. But hold on. Now I want you to think about it. Let's say the market goes lower from 1 million, goes down to $500,000. Mr. A has run out of cash, right? Because all his money is stuck inside. What about Mr. B? Mr. B still has $750,000 cash in his hand. Can he buy, go and bargain hunt, buy at $500,000? Can or not? Yes, correct. So maybe a few years later, the market recovered again. The price went back to $800,000. Mr. A is still looking at 20% loss, correct? But Mr. B, the first property he bought at $1 million, the second he bought at $500,000. Total cost, average cost of the house is only $750,000. He can actually sell and even make a profit, correct? So actually, by taking loan, you can actually reduce your risk and increase your returns. So how many of you plan to buy a house? Quite a few, right? So do you want to know how you want to set the budget for the house? No, huh? No, then I don't share. Okay. Come again, huh? You would like to know how to set the budget for a house? Yes, okay. This is what I'm going to share with you. Basically, first you need to decide how much you should borrow. Firstly, the debt service ratio should be less than 35%. So what do we mean by that? Basically, you total up your total money debt repayment. So for instance, you have a car loan of $1,000, you have a housing loan installment of $2,000. So your total debt repayment is how much? $3,000. That's right. Then you divide by your gross income. I repeat, it's your gross income. Because CPF is still money, correct? A lot of Singaporeans always don't calculate CPF. And the figure should be less than 35%. If yours is more than 35%, you have over-borrowed. So by working based on this, we can then work out the budget. So assuming the debt service is 35%, assume you take a 25 years loan, the interest rate average is 4%. You know, I'm quite conservative, right? Currently, interest rate is only about 2%. So if you have a household income of $3,000, your maximum installment is 35% of it. So simple maths, 1050. The next thing you need to work backwards, what's the maximum loan you can take? And for this, sorry, you cannot use a simple calculator. You need to use a financial calculator, or if you don't have, simply just approach one of my staff, or you can even go to our website for the calculator. So the maximum loan is $200,000. And if this is 80% of the purchase price, so the maximum purchase price is $250,000. Everyone clear how I work that out? Can? Okay. Maybe I'll show you another example. So for instance, this person earned a household income of $12,000. 35% will be $4,200. We work backwards again. So if you want to buy a $1 million property, you better have a household income of how much? At least $12,000. At least. More than that. So how, next step, of course, after you buy a house, right, you must plan for the housing loan, correct? So how should you plan? Firstly, like I mentioned, look at your own financial situation. The debt service ratio should be 35% or lower, as we have calculated. Secondly, you must have some spare cash or CPF. Do not use up all your CPF or cash when you buy the house. You should stand by some additional amount so that in case you lost your job or there's a pay cut and so forth, you can still pay your installment. The loan should be fully repaid by age 60 or whenever you want to retire. And of course, you must gauge is there any impact on your future plans. For instance, you don't want to buy a big house, spend all the money there, then you don't have money to send your children to university, correct? You also don't want it to affect your retirement plan. So next thing, of course, after you have a housing loan, actually, every few years, you should actually refinance your housing loans. In other countries such as Australia and US, most people will actually refinance every 2 to 3 years. Why? Why do they do that? In the past, most people actually stayed with the same bank. Just like in the past, most of us work in the same company for the whole lifetime, correct? But nowadays, people are smarter. Why do they refinance? Refinance basically is just to switch to another bank. Why is switching better? Just like mobile phone operators, right? Sometimes Singtel, StarHub, they'll offer freebies, right? Free gifts and a lot of attractions for new customers. Yes or no? Correct? Yes. So the same happens for the banks. So the reason is banks typically offer better rates for new customers. So let's say this year you are with Bank A. 3 years later, you look around, if Bank B offer better, you move to Bank B. It's as simple as that. There's no number portability issue, right, with housing loan, right? So it's very easy to just switch. And of course, the next thing is you can even take cash out of your property without selling it. Now we are having a crisis. People say cash is king. But you say, I don't have cash. What to do? Maybe you should look for us. Maybe we can help you get some cash out of your property. Let me show you an example how to do it. For instance, you bought the house for $1 million. The current market value after the last few years, maybe it went up to about $1.5 million. So let's say your current loan outstanding is just $500,000. So actually in this case, you can actually get an additional loan of $500,000. You increase the loan back to about $1 million. And the debt to asset ratio is only 67%. It's actually quite safe. Even if property prices falls, this debt ratio is actually quite comfortable. So how do you strategize to refinance? So the first thing, of course, you need to decide whether you want to take fixed rate or floating rate. So of course, typically you must understand, the banks are the same as you. You are afraid interest rate goes up, right? Banks are also afraid that interest rate goes up. So if you say, I want a fixed rate interest rate, right, they will give it to you, but at a higher rate as well to protect themselves. So what happened? Currently, the fixed rate is about 2.88%. The floating rate is about 2.28%. So it depends on your view, how you see interest rate moving in the future. The second thing, of course, you need to consider is the lock-in period. Typically, fixed rate packages come with 2 to 3 years of lock-in period. On the other hand, SIBOR packages typically come with even 0 lock-in period. It means there's no penalty period at all. What's the advantage of a shorter lock-in period? It gives you flexibility. If you want to sell your house 6 months later, you can sell. You want to sell it 1 year later, you can sell. You can also refinance, move to another bank, without paying penalty. So next thing, the bank will help you pay for some of the costs. Some people thought that they have to pay all the legal fees. Yes, actually in Australia, you have to pay all the legal fees yourself. But in Singapore, we are so pampered because the banks are so competitive, they actually help you pay for most of the legal fees. How much do they pay? 0.4% of the loan amount. So for instance, your loan amount is $250,000. Then the legal subsidy will be $1,000. They also help you to pay for fire insurance, typically at least 1 year free. So how much would that benefit be worth? It's about $100 over $200.